One sees no rate cuts this year. The other still sees 4. Joining us now, Ironside's Macros Director of Research, Barry Knapp, and Bank of America's Senior Economist, Aditya Bave. Welcome to both of you. Aditya, you're a little more out of consensus at this point, which I can't even believe I'm saying. But why do you still think 0 may be the way we go?
Well, thank you for having me. We think the activity data have held up really well, and inflation is nudging to the upside. So if you look at what the concerns have been with consumer sentiment, business sentiment, it's not just weaker activity, it's stagflation, right? So it's weaker activity with higher inflation. And then you think about how has that sentiment materialized to the extent that it has? Well, it's materialized in inflation. We've had these upside surprises in inflation, and we haven't really seen the impact of tariffs yet. Despite that, inflation's been a little bit higher than expected. Meanwhile, activity is holding up. This, from our perspective, was a very strong retail sales report for February. December looked like an unsustainable surge. Well, guess what? The control group is back in level terms to where it was in December. So this was good news on the consumer.
Kelly, let's me and you score this.
Well,
okay, let's get Barry go.
I was going to say, if this sounds
Round
persuasive,
1.
Just wait.
Just wait.
Because Barry somehow is going to have to make this sound, wildly optimistic. Barry, welcome. And you still see 4 cuts. Why?
Well, I would say, first of all, one of the things that Steve didn't mention and the other guest didn't mention is that the Atlanta Fed PCE now forecast went from a little over 1%, 1.1, down to 0.4% after retail sales. So they're flat, essentially close to flat so far this quarter after being up 4.2 in the prior quarter. When we turned negative 3 weeks ago and forecasted a pretty good move in Treasury prices higher, we had 4.20 as our target for the 10-year yield. We got there in a week. We had a down 10 to 12% correction priced in for the equity market. Our idea was, and we expressed it a little less colorfully than Treasury Secretary Bessent did, but our idea was, we had a positive 50 basis point contribution from government spending in the fourth quarter and a negative 50 basis point contribution from non-residential fixed investment in the fourth quarter. We were going to make that transition through the course of the year, but that meant weaker growth in the first half and potentially a pickup in the second half if that business confidence surge that happened over that in the post-election period held in. Now, it was dealt a setback in February, and so we're likely to have weak CapEx through the whole first part of the year. Consumption looks like it's softening, and government spending is likely headed on a lower trajectory. All of that, to me, sits on top of a labor market that we've been describing as very unstable, not stable full employment like Goolsbee argues. We've had churn in the labor market just absolutely collapse to levels we haven't been at since 2013, as evidenced by things like the Atlanta Fed wage tracker switchers versus stayer series, or just this broad measure called reallocation, where you take the sum of hirings and separations over the size of the labor force. And we have wage pressure in the lower skilled cohorts. That lowest income quartile wages are growing 0.4% below the highest quartile from plus 3.6% in January of 22. So to me, the labor market looks like it's in a precarious spot. If you throw a bunch of government contractors and government employees out of work, that could really tip the balance. And last month's employment report to me was a mess. I mean, the U6 going up 0.5%, job finding rates near its all-time low in the history of that 30-year history of that series. I just think we're in a precarious spot. And
Barry, you make some good points, Barry, but I don't think you should.